Yo, what's up, everyone? It's your boy Looney back with another real one. And today we're talking about the wheel strategy. And this is one of my go-to option plays. But more importantly, we're talking about mistakes, the kind that I have made early on that I wish someone else should have warned me about or really emphasized the issue. If you're new to selling cash secured puts or covered calls, this is for you. Before we get into it, quick shout out to the Discord community, free to join, and then I have a premium version. It includes my trade alerts, courses, coaching, and live calls. All links are in the description. All right, let's break down 3 rookie mistakes I've made running the wheel so that you don't have to make these mistakes. Number 1 is picking the wrong strike price. So strike selection is very important. Early on, I caught on, and then as I moved on, I started to get greedy, and I ended up choosing strike prices that were way too close to the current price, and I'm basically asking to get assigned. Sure, the premiums at the time were nice, but I ended up owning stocks at prices that didn't age well. Now, I always ask before I make the trade, would I actually want to own the stock at this price? If the answer is no, I end up just skipping the trade or lowering the strike, especially on volatile days. The smart move is to go further out of the money. Even if it means collecting less premium, long-term does win over short-term gains. Now, let's pull up Riot because it is one of my biggest positions in my portfolio. It actually is my biggest position. It's at 18%. I'm down 18% on this. And I ended up picking strike prices that are just way too high, way too close to the money. And that's why I'm negative. If I really just took it slow and not put all my money into one at one time, I could have emphasized or took advantage of the lower prices and get in at better discounted price and even collect premium. So Riot, I ran into that issue a lot. I had the opportunity to get at a lower price. I decided not to just because I'm already at 18%. I didn't want to over allocate all of my money. So that's why I held off on it. And that's why it's at an average cost that I'm not really proud of. I'd like my average cost to be at that $7 range, but this is a long-term play, so I can't be too upset, and that's why I'm selling more puts. I even sold a put on this one at 5.5. That is doing pretty well. It is up $19 or 65%. This is an example that I give out to my premium members in my Discord, and that one is performing pretty well with a low collateral needed. Second mistake is misunderstanding delta. Now, I wouldn't say I don't understand delta, but it's more along the lines how important delta is. And delta actually tells you the probability of assignment. So if you have a delta of 50 or 0.5, you've got a 50% chance of getting assigned. Now, I'll just show you real quickly. If we pull up any kind of trade that won at the $7.5 call, I know it's on the sell call, but still works. That 0.53 basically means that I have a 0.5 chance of getting assigned. Now it's a little off because of that 0.53, but about a 50% chance of getting assigned. And I was blindly selling puts with deltas of 0.5 or 0.4 or sometimes even higher. And I was thinking that I'll be fine. The spoiler is it wasn't the worst thing in the world, but I could have done deltas at a lot lower prices and just collected less premium, similar to the last one. And now I'm staying closer to that 0.20 and 0.30 delta. That is the sweet spot, especially when selling options. It gives you solid premiums, but you're also not playing chicken with assignment. Lower delta does mean safer trade, but if I do go higher, it's only on stocks that I love at that price with enough cash ready to scale in. So if the stocks end up falling below my cost basis is the time that I'll start doing higher deltas and closer strike prices. And that's how I'm going to allocate my cash, because I do have $2,000 in cash set aside for any kind of trades. And lastly is overexposing to one stock. Now, I briefly went over this with Riot, but my final mistake was overexposure. I got way too heavy on stocks like Riot, and I'd get assigned. And then I'd keep selling puts on the same ticker. Before I knew it, 20% of my portfolio was in a single name. And when that stock dropped, my whole account bled. So my diversity is very low. And unfortunately, that when Riot falls, my account falls with it. And it's very reliant on that stock. So now I really cap my exposure and I try to be below that 20% per position. There are 4 stocks or 5 stocks that I want to be heavily invested in. I have about 3 out of the 5 that I know that I really want to. The other 2, I'm a little undecided, but that is what I'm trying to do. I'm trying to get about around that 20% for all of those. I don't want to overexpose into one. Now, the wheel does work best when you're diversified and emotionally detached, because now if Riot goes down, that doesn't mean that SoFi is going to go down, and vice versa. If SoFi goes down, that doesn't mean that Riot's going to go down. They're not interlinked. Yes, they do act somewhat similar because they're basically tied to the S&P like most stocks, but Riot's a little bit more cyclical. It's revolved around Bitcoin prices and movement, where SoFi is really about how the company is doing and tech company and all of that with the banking industry. So they are similar, but they do act differently. And that's why selling puts, being diversified, is very important when doing the wheel strategy. And it doesn't wreck your whole strategy if one trade goes sideways. So just to wrap up, remember these 3 things. Pick strike prices that you're comfortable owning. Now, ideally, you want to pick strike prices that are below what the stock is trading at. And if you own the shares, you want even below that. You want to own at prices that are lower than your average cost. So that's ideal. Now, it doesn't work perfectly. If the stock is trading above your average cost and you still want to sell puts, you still think it's a good time to invest, maybe not allocate as much. And I'm kind of skipping the second one, but that's why I wanted to say you never want to overcommit to one stock. So you want to keep cash aside and wait for better entries. You don't want to go all in on one stock at one time, because if it goes wrong, then your whole account goes wrong. Lastly is more fundamentals, and that's understanding delta. And it's very important because it's two-way street. I mean, it tells you your probability and it tells you how much the option will move, increase or decrease depending on price movement of the stock. So it's very important, and it's a great indicator to use when selling puts, selling calls. Honestly, option trading in general, delta is very important, whether you're buying or selling, but very crucial when you are selling. And let me know if you're trying the wheel or already running it. Drop a comment. And then also tell me what's been your biggest lesson so far. And if you want to see how I run it in real time, you get to see all my trades, my setups, and my breakdowns. Check out the premium Discord in the description. Like, subscribe, and I'll catch you in the next one. Peace.